The latest energy crisis has painted a bleak picture for how reliant the UK is on fossil fuels. Energy prices are set to soar, with a tough winter ahead for lower-income households. Fossil fuels still accounted for 38.5% of electricity generation in 2020. So how far is the UK away from a renewable transition? I spoke to investors in the clean energy sector to get their viewpoint.
If you think of last year, 43% of electricity was generated from renewables. And over the last 10 years, fossil fuels have dropped by 60% in their generation of electricity. So there's huge progress at a headline level. But when you look behind the numbers, there's a greater challenge there. Electricity is only one part of the energy that we have in the country. Think of transport, where the vast majority is made up of oil. Less than 1% of transport energy comes from renewables. And then you think of home heating, where 80% of energy is met by gas. Thinking about what renewables generate in total for UK energy, it's only about 4%.
A common criticism of renewable energy investment is that it has largely been propped up by government subsidies. But is this still the case?
The cost curve for low carbon sources of power generation has come right down over the last decade or so, and it continues to fall. So, you do have unsubsidised wind and solar assets in operation right now in the UK.
Different forms of renewable power and efficiency and etc. can work in different areas at different times with different subsidies. So it's no one kind of rule for everybody. Solar is tougher than it is for wind here from a subsidy point of view. Against that, then the cost of solar generation or the cost of manufacturing solar cells continues to fall dramatically. The cost of building wind turbines as they get bigger and more efficient on a per megawatt hour basis, again, continues to fall. There's bumps in the road with raw material cost inflation that we're getting at the moment, but the trend is typically downwards and will continue to be that way. Lithium-ion batteries again. So that would point towards, let's say, electric vehicles being economic versus internal combustion engine vehicles in sort of 2023, 2024. So at that point, subsidies really will no longer be required.
I think this is one of the successes that the government has had over the last decade. They did subsidise renewable energy, but now what we're seeing is actually renewable energy, wind and solar, is very competitive with fossil fuels. So that has worked. We see that in the auctions, and I think that potentially makes people think that wind energy is not as profitable as fossil fuels, because the headline auction numbers show the returns are quite low, but it's more complicated than that. When you look into these auctions that the government is running, what risk-averse investors are doing are locking in bond-like returns. So when we hear about returns of about 4%, that is for very conservative investors. They're not taking any development risk. They're purely looking for long-term cash flows. When you think of other players in the renewable market, other energy players, they can extract much higher returns because they will take the development risk, they will take some merchant risk. And when you think about energy prices today, instead of locking in that long-term price with the government, you're able to take advantage of the high energy prices in the market and sell into that. So I think, yes, there's absolutely a place for renewables, a very profitable place, and some very attractive returns. The government is very clear, they've been making it clear at the Conservative Party conference, that nuclear is something that they're looking at to counterbalance that intermittency with renewables. Now, of course, what has happened in this country in the last 20, 30 years is that we have underinvested in nuclear. And nuclear has its problems. There's a lot of opposition from society against nuclear plants. But it is a low fossil fuel option, and it does have the stability and the ability to generate throughout the different seasons. So it is a great option to put against renewable energy. The trouble is, as I said, we haven't invested in this country for the last 30 years. When Hinkley Point C opens up in 2026, it will have been more than 30 years since we opened the last nuclear power plant here. We generate 17% of electricity from nuclear. Think of it in France, where they generate over 70% of electricity from nuclear.
There are sort of probably quite well-known hazards in relation to nuclear. And it becomes quite a controversial power generation source, I suppose. But it's also quite expensive on a relative basis as well.
Our biggest overweights are within that electrification trend. especially within the electric vehicle area at the current time. So slightly more demand oriented than supply oriented. And historically, we found some of the better long-term returns with lower volatility have come from some of those businesses. It's always a fast-moving area. There are many cycles going on dependent upon different sort of product areas, as well as the bigger cycles around investment and policy.
If you think about it from a growth perspective and you're looking at growth companies, then you're looking at companies that have the potential to develop these new technologies, to invest in wind and solar. But from our perspective, the actual opportunity is to invest in the existing energy companies that are transitioning into renewables. The large oil majors, the likes of BP and Total, they're putting significant capital to work in developing offshore wind. And it also comes at a time when these companies are priced very cheaply. Now you can contrast that to the pure plays in wind. Take for instance Ørsted. It's done an amazing job transitioning from a coal company to a wind company. But in the last 12 months or so, from the peak price, stock price, to today, the stock has nearly dropped 40%. So that shows you there's risk there as well. So you have to bear in mind both the valuation and the future opportunity. Now, if the energy majors get this transition right, they've got the cash flows coming from the fossil fuels that they have as they run them down to invest in that renewable opportunity.
From a big picture point of view, the energy industry, we see investment of about $2 trillion per annum. Obviously, a lot of that is on fossil fuels at the minute. It needs to change. If we're going to accelerate that transition and get to net zero 2050, as the IEA would target it, then we need to see the investment rise to $5 trillion per annum. Now, we need the super majors to be part of that. We can't exclude them and say, your capital is bad, disappear. The super majors are typically the better placed and most progressive of all the oil companies that are out there. The companies that we really need to get coming along is Pemex and PDVSA and Rosneft and Saudi Aramco, big allocators of capital, national oil companies. They need to make the switch away and start to grow transition businesses, greater efficiency businesses, lower carbon businesses. So it's unfair, I believe, to pick on those super majors as being the bad boys. They are, for me, very much part of the solution rather than the problem. And their transition is well underway, but it does have a long, long way to go.